McDonald's will report results this week, and there are a few things that we'll be watching for. One is whether or not the traffic will hold up with the continuation of the all-day breakfast. And then we'll be looking for strong guidance out of fiscal 2016 as a result of the McPick 2 promotion, which started at the beginning of January. So in this video, we're going to take a look at where management's guidance from the last shareholders meeting stands relative to consensus estimates. And for the guidance, we're going to go to the SEC filing for that meeting. You scroll down to the other event section, you can see that they give details of that guidance. And then we'll be using our earnings model, which you can download for free on our website, gutenbergresearch.com. If you click on the free models tab and then scroll down to the McDonald's model, you just click this button, you'll see it pops up. And if you're new to our modeling approach, click on the education tab and you'll be able to download a document which explains the entire approach. And in this document we use Apple as an example, but it's the same methodology used for all of our companies that we cover. So now going back to management's guidance, you can see that the first target is that they increase their expectation of the percentage of franchised restaurants versus company owned. So that's 93% by the end of 2018. And now if we go to our model, and you can see down below the income statement we have the details of our different segments. So you see this section up here is company operated restaurants, and then this section here is the franchise restaurants. And we do have an equation that gives us the percentage of company owned to franchised. And you can see that by the time we get to fiscal year 2018, we're at that 93% target. And then the management's long-term guidance on franchise restaurants is up to 95%. So you can see we haven't adjusted. We're going to wait until they make some more progress because they're really only at 82%. So once we get closer to fiscal 2018, we'll start to increase the late years. So next, management gave us some guidance on GNA savings. So they're going through an initiative to reduce their GNA. And they give it to us on a constant currency basis. So that's not how we model our earnings. So basically we know that this 20% reduction that they're expecting off the base of 2015 by the end of 2017 will be a bit lower when we look at it in when we're not looking at it in constant currency terms. So if you scroll back up to our income statement, you can see we've got SG&A on row 16. And we just did a quick back of the envelope calculation to see what the percentage change in our model is relative to the start of 2015, which is the end of 2014. And we're at a 15% reduction. So not at the 20% reduction that management is guiding to, but keep in mind that this is not on constant currency basis. And if you'd like to download this model and put in your own SG&A assumptions, you can do that. So it's a quick item to change in the ratio section down below the segment details. So you can see here we've got SG&A growth calculated. And then to change the actual SG&A, you'd have to change the operating margins in the company operated and franchise restaurants, but pretty easy to change. Okay, after SG&A, they give us details for the dividend, so that's an easy one. They updated their dividend. You can see it at the bottom of the income statement. And then they give us some details on the cash return to shareholders. So they're targeting $30 billion in their 3-year program, which ends in 2016. So if we scroll back down to the bottom of our segment details, you can see we do a calculation of the 3-year capital program. So this is adding the return in terms of dividends and share repurchases. And we have to make a few assumptions on the share repurchases here. So you can see we need to make assumptions about the price that they repurchase the shares for and the amount in each quarter. So we've kept it constant at $115 per share and $2.3 billion of repurchases for each of the next 5 quarters. And that, along with the dividends at the current dividend rate, gets us back to $30 billion in that 3-year program. So you can also change these assumptions as well. So now, after incorporating that guidance into our model, you can see that our consensus-based estimates are in line. So we've basically been able to incorporate all those items and still get back to the consensus estimates for the next quarter and the next 4 quarters, actually. And then if you scroll down, there's just a few things. So you can see the operating margins for the company-operated restaurants and the franchised restaurants. These are probably the 2 most important metrics to watch. And you can see that in order to get back to that consensus EPS estimate, for the next quarter, we're coming down quite a bit, which is pretty typical for the December quarter. But then for the next 3 quarters, we actually have to increase those estimates pretty significantly. So you can see in the 3rd quarter of fiscal 2016, we have to get up to 82.7% margin on the franchise restaurants and 17.3% margin. And that's just to get back to the consensus EPS estimate. So that's pretty significant, and it's a little dangerous that the fiscal year 2016 earnings are so back-end loaded. But the company has been executing on growth, so we'll see what this quarter brings. So now that we have our estimates in line with the consensus, we can scroll down to the valuation section and take a look at where we stand from a share price standpoint heading into the quarter. So on a multiple basis, we are right about at the midpoint of the average next 12-month based price earnings ratio on an ex cash basis. So we're at about $115 per share. So that means there could be a little bit of room for multiple expansion if this quarter is a strong quarter. And then below the multiple section, we have our DCF-based valuation, which is showing a much higher valuation at $130 per share. And that's based on the beta that's below the market estimate and a 17% implied volatility, which is a little bit lower than what we had last quarter. So be sure to check back after the company reports. We'll update this model and see what the valuation impact is. And also join us later this week for the Amazon results, Facebook, Microsoft, GoPro, and Alibaba. And if you're interested in financial modeling, please be sure to subscribe to our channel.